Hey investor friends, I'm Michelle Markey and today I'm going to cover the differences between health savings accounts, flexible spending accounts, and health reimbursement arrangements. These are all tax advantaged accounts that can help you pay for covered healthcare services and qualified or eligible medical expenses. And some of these include deductibles, co-pays, co-insurance, dental, vision, prescription drugs, and in the case of a health savings account or HSA, you could also use the funds that you have saved up in an HSA towards, if you're unemployed, like a COBRA health insurance plan premium and other related expenses. For those of us fortunate to have a job during the conditions of the coronavirus pandemic, it can be really advantageous to participate in any of these kinds of plans, whether you're going for an HSA that has a high deductible requirement or a FSA or an HRA that are offered by your employers and linked by a health plan. And I'm going to favor more so the HSA because I realize some added benefits that are useful for someone in my position who's interested in a high deductible plan because I'm generally healthy and I don't have a lot of medical expenses throughout the year. But for people who can predict what kinds of medical expenses they'll have during the year, an FSA plan may be more useful to them. And also there's child care or dependent FSA, which can be really helpful for parents who are at work or school and they need to cover child care services. So having an FSA dedicated specifically to that could be very helpful for parents who are in need of planning for that kind of payment. And unlike the FSA and HRA plan, which are owned by and must be set up through your employer, you as the employee or self-employed person or even sometimes unemployed persons can set up an HSA account provided that you meet the qualifications to have an HSA account. And this is one of the many reasons why I like the HSA account over the other kinds, because the account is yours forever, whether you stay at the same employer or move on to the next one. But a few things to keep in mind. It requires that you're paying a high deductible plan. So if you end up having medical expenses, you're going to pay a high deductible, but at least you enjoy lower premiums. And a few more caveats include, if you switch to a health insurance plan that isn't a high deductible plan, then you're no longer eligible to contribute to an HSA. And if your employer chooses to contribute, it can't be more than the total annual limit that between both you and the employer that you're allowed to contribute per year. So you could, for 2020, contribute the full $3,550 in the year, or your employer can contribute a portion of that, but it can't exceed that limit. And then also, any excess contributions are taxed at another 6% and are not tax deductible. And then there's something called a testing period, which involves the first day of the last month of the current tax year in which you become eligible. So for most taxpayers for an HSA, you become eligible as long as you have the health plan and HSA account set up by December 1st of your current tax year. And when you have that open by December 1, there's a testing period of another 12 months into the next year that you need to be eligible to be allowed to keep contributing to the HSA. So if you're eligible December 1, you have to be eligible through December 31 of the following year. So let's take December 1, 2020, and you keep eligibility through December 31 of 2021. The awesome thing about HSAs is they're considered a triple tax advantage, and this includes contributing pre-tax dollars from your work payroll that are considered tax-free, and withdrawals from this account for qualified medical expenses are not taxed. And then, best of all, you grow what's in the account at a tax-free rate. So you don't have to pay taxes on what you're investing in from this account. So you could be investing in stocks, ETFs, bonds, index and mutual funds, and a few other things, and you don't get taxed on what you earn in those accounts as long as you're withdrawing it for qualified medical expenses if you're under the age of 65, because otherwise you'll get a 20% penalty. But the awesome thing after that is after age 65, you only have to pay income tax on any withdrawals you make from an HSA account, and you could still withdraw it tax-free for qualified medical expenses. But the awesome thing is you could withdraw it for any reason and you just pay income taxes. So I'm looking forward to being 65 and withdrawing this money. Hopefully I don't have to use it for healthcare expenses, but that's a pretty awesome perk to have. Compare this with an FSA plan where if you don't use the funds, you lose them at the end of the year if you don't use them, with the exception of being able to carry over $550 to the next year per a recent May 2020 IRS rule change. And it's too bad you can't invest this money in any kind of investing vehicle, and you just kind of use it for either healthcare reasons, or FSA, like I said earlier, could be used for dependent care or child care services. So those are some of the benefits that an FSA offers that are worth considering. And I know I haven't said much about the HRA accounts yet, but I'll get into more details in the following table where I outline some of the key features of an HSA, FSA, and HRA account. In this table, I'm going to highlight the key features of the HSA, FSA, and HRA plans. And I'm not going to read every single detail on this table, but you can press pause and read more throughout the table where I've illustrated some more important details. But some of the things to start with in an HSA include you have to have a high deductible health plan where the plan needs to meet at least $1,400 of a required deductible for an individual or $2,800 for a family. And this is not required for the FSA and HRA plans in comparison, but those are only available if an employer offers it. And then for the health savings account, you also have an annual out-of-pocket maximum of $6,900 as an individual or family, $13,800 for your required annual out-of-pocket max. And then when it comes to how it's funded, an HSA is employee-owned and funded, while your employer may contribute, but that's optional. And it's similar with an FSA, where the employee funds it, and the difference is that it's owned by the employer. So that's a bit of a not fun aspect of an FSA, where the employer can keep the funds that you've contributed if you don't use all of the money that's in the FSA after a current tax year. And then when it comes to HRA, that's employer owned and funded. And then the other thing to keep in mind with HSA is that you can have an annual contribution of $3,550 as an individual, or family $7,100. And then if you're age 55 and up, you can contribute a catch-up of $1,000. And the limits for FSA include, for the healthcare FSA each year, $2,750, and dependent care FSA is $5,000, and you are allowed to have both at the same time, so that's a nice perk. And then with the HRA, this is usually connected to a health plan, and it's determined by the employer how much there might be a contribution allotted to the HRA plan. But apparently you can usually start spending on the HRA on the day one of having that plan, but your employer may set some usage rules. And then the biggest benefit to using an HSA, like I said earlier, includes tax-free contributions, qualified medical expense withdrawals, and investment growth. And then you actually end up saving more when you contribute pre-tax dollars in your taxes than if you contribute after-tax dollars, because even though the after-tax contributions are tax deductible from your federal income taxes, you actually end up saving more if you do the calculations in the pre-tax contribution by taking it out of your payroll. And then other things to keep in mind is that you can't even invest the money that you have in an FSA or HRA account, but you can with an HSA, so that's a huge bonus in my mind. And then there's a few more conditions that you probably want to keep in mind when it comes to whether you can roll the funds over. That may or may not be guaranteed when it comes to an HRA, but you always get to keep the funds that you've contributed in an HSA. But like I said earlier, you probably would lose the money with the exception of $550 rolled over in an FSA plan. And then the other thing I mentioned earlier is just keep in mind that you lose the FSA and HRA account if you change employers, but you own the HSA forever. So that's pretty awesome. I know there was a lot of information to take in, but I'm just so glad I learned about the power of an HSA and how it can help me with my retirement goals, and also the advantages, pros and cons of an FSA and HRA plan. And either way, some people need a different separate savings account for just health expenses, and that's totally fine. So whatever meets your needs the most, feel free to use that type of account. And if you enjoyed this video or learned something, please like and subscribe. And if you have questions, please leave them in the comments below and I'll do my best to answer. Till next time.